One of the most important measures to know about when investing in the stock market is P/E ratio. In this video guide, we're going to discuss what P/E ratio is, how it's calculated, what the number represents, how to use P/E ratio to compare stocks, and common pitfalls when evaluating P/E ratio. So P/E ratio stands for price to earnings ratio, and it's calculated by taking the price per share and dividing it by annual earnings. So the higher the earnings per share are, theoretically the lower P/E ratio is going to be. And annual earnings is calculated as the sum of the last 4 quarters rather than by fiscal year. So every quarter when a company reports its earnings, the P/E ratio will update accordingly on common sites like Google or Yahoo Finance. So P/E ratio, what does it actually mean? This number represents the amount of dollars you will spend on shares to buy a dollar worth of earnings. So the more a stock earns, theoretically, the more expensive it's going to be. So and P/E ratios tend to be similar across similar stocks in the same industry, but different industries tend to have their own P/E ratios. What I mean by this is the more stable an industry is, generally the higher the P/E ratio. As an example, something that's not very stable like technology, companies that are growing very quickly still tend to have relatively low P/E ratios because technology is changing so fast, there's no guarantee that 5 or 10 years into the future that company will even be relevant. So also, P/E ratio is higher as a company grows faster because the investors are trying to think one step ahead. So if a company is growing very quickly, theoretically its earnings will be up a lot in a year or 5 years, and therefore the share price will go up as earnings go up. So P/E ratio is a really good way to compare stocks and trying to figure out what is a real value. And to help illustrate that, I'm going to quickly compare a few stocks. So we're going to get out of this, and I've already pulled up a few common companies in Google Finance, and what we're going to find is that we're looking at McDonald's here, and we'll see the P/E ratio is 17. That means the earnings per share, if we go to financials for quarterly, if we added up the average of these earnings per share, and then you would actually add these all up because this is by quarter, so the number would be something like 5 point something, and then took this $96, divided it by the 5 point something, we would get this 17.4 value. And basically, the lower the P/E ratio, the cheaper the stock, the higher it is, the more expensive it is. So let's compare McDonald's to another stock in this industry, Chipotle. We'll see that the P/E ratio of Chipotle is almost 54, much higher than McDonald's. So the main difference between the P/E ratios here, you might be wondering why investors are willing to pay 3 times more for a Chipotle dollar's earnings versus McDonald's. And that has to do with growth rates. If we look at financials for McDonald's, then look at the quarterly data, we'll see that in the 3 months ending here versus a year ago in the same quarter, there's not much change. There's very slow growth at McDonald's. And if we look at the annual data, we'll see the same thing. So between 2009 and 2010 and 2011, we saw a nice uptick in stock price, and as a result, McDonald's went up a lot during that time. But in the last year, they've barely managed to increase their profits or revenue by more than a couple percent. And we'll see that earnings too, very small changes here. And when earnings don't go up quickly, investors don't want to pay a lot of money for a stock because there's no incentive to. In the future, McDonald's is likely not to be worth much more than it is today, so why would they pay a premium for the share? Whereas if we look at Chipotle's financials, we can see that there's significant changes on a quarter-by-quarter basis. We can see from a year ago, the same quarter, the stock's almost pulled in 15 or 16% more revenue. And if we click on the annual data, we'll see massive growth rates. In 2012, Chipotle almost did double the revenue it did in 2009. their investors are thinking that if in this 3-year or 4-year span, Chipotle is able to double its revenue, in 4 more years it might double it again. It probably won't hit that growth rate because companies naturally slow down as they become more valuable. Just from the law of large numbers, there's only so many stores they can build. There's only so quickly they can expand. So when comparing profits to earnings ratio, you can't just assume that one company is a better value than another just because its PE ratio is lower. You have to consider the profits or the growth rate of the profits. So if a company is generally, it's very correlated. Said if a company is growing twice as fast as another company in the same industry, the PE ratio is usually twice as high. If it's growing 3 times as fast, it'll be 3 times as high. That's a fairly easy way to compare the two multiple stocks within the same industry with different PE ratios. And finally, I wanted to discuss some common pitfalls of profits to earnings ratio. So if you look at Amazon, we'll see that the PE is in over 1,000, which is not the norm for a typical stock, but you can't really say that Amazon's overpriced. Once you look at the financials, you're better able to understand how this company's revenue is driven, or how this stock is driven. Because when you consider profits to earnings ratio, it's earnings and not revenue. Earnings is how much money the company takes home, whereas revenue is how many dollars pass through that company. So Amazon is investing all of their profits into new infrastructure. That means that the earnings are going to be very low. So Amazon looks like they're very expensive, but it's really just because they're not making any money. But if you actually look at the balance sheet, we clicked on financials here, and then annual data, we'll see that Amazon, not Chipotle, has grown revenues at incredible rates. So in 2009, they did $24.5 billion worth of business. In 2012, they did $60 billion. They've gone up 2.5 times in revenue. And when revenue increases at this kind of skyward rate, people are thinking that this year they'll make 70-some billion, and it'll only be a few more years before $100 billion is passing through that company every quarter. And if Amazon cuts down this $4 billion research and development fee and some of these other expenses, then they're going to be able to take this gross profit here and really expand it. Really be able to make this their earnings eventually, but that's only once they've completed their infrastructure. So you can't always look at PE ratio, especially with a growth stock like Amazon. In fact, I would really like to see this because it means to me that Amazon still has good ways to spend their money. When a company has a low PE ratio, it's generally saying that either their growth is slowing or even negative, or they just don't have any good way to use their money. So there's lots of earnings to be had because they just can't find things to spend it on. Amazon's spending their money very efficiently, and as a result, revenue is growing quickly while PE is, not even comparable to other companies. And finally, I wanted to discuss one more pitfall. That's a cyclical stock. So a company like Deere & Company is cyclical because they produce a lot of machinery. And when the economy is doing well, companies and farmers are more likely to buy more machinery because they can afford it. And what happens is a revenue for a company like this is going to go up during when things are good, and so are earnings. So what happens is when people are buying a bunch of machinery one year, the PE ratio might look really low because earnings might have gone very high, whereas orders for the next year might be quite low. So you can't always judge what they call a cyclical stock based on its PE ratio. PE ratios for cyclical stocks tend to actually be very low when the economy is good and very high when the economy is poor because they don't sell much when the economy is poor. So another thing we're going to look at is the financials here, and we'll see that in the last 3 months compared to a year ago, Deere actually contracted a little bit, and that's never good when revenue is barely growing, or here where revenue is shrinking. People are thinking that while the company made more money, its revenue than it did a year ago in the same quarter, it did less revenue, and that's scary to an investor to think that the business is contracting. So that's also going to push down PE ratio. So now that you know what PE ratio is, again, it's price to earnings, and how it's driven, mostly by growth and future prospects. PE is based on the future. If a company is growing quickly, its PE is going to be very high. And it's also based on industry. Restaurants tend to command a high PE because they're pretty stable, whereas tech companies tend to command a low PE. And just so you know, the average PE in the S&P 500 is just under 20 at the time of this video. That's kind of on the high end, so stocks are priced, because the economy is good, people are bullish on the stock market, and interest rates are really low. That just generally inflates the PE of all stocks. So that's about it for this video. I want you to subscribe to my channel and check out the link in my description if you want more information on PE ratio and stock investing in general. Thanks.